My name is Jake, welcome to the channel. In today's video, I want to talk about the simple path to wealth based off of your time horizon. On my channel here on YouTube, I talk a lot about how to invest based off of your investing time horizon, as well as I talk a lot about simplifying your investing strategy. And I've made two separate videos on these topics. A few months ago, I shared an entire video on how to invest based off of your time horizon. And then a few weeks ago, I shared an entire video on the simple path to wealth, comparing investing into VTI, with the traditional FIRE movement versus investing in the simple path to wealth with dividend investing, and really focusing on two strategic ETFs being SEHD and DGRO. In today's video, I want to talk about both of those topics and combine them and answer a lot of your questions that I've gotten from these videos. I've gotten dozens and dozens of questions around why DGRO and SEHD, why not this, why not VYM, why not consider this? And there's so many different questions, there's so many different time horizons. It's really difficult to address every single individual personal question and scenario on a YouTube video here, on YouTube that I'm addressing a mass audience. And so in today's video, I want to break it down and I want to talk about individual time horizons and share some thoughts around why I'm suggesting the simple path to wealth based off of your time horizon. And I'm going to give you a lot of things to think about based off of your time horizon. Because if you're new to the channel, my wife and I, we've gone through this exercise these last 7 years. 7 years ago, I was in a job that I absolutely hated, and I was so stressed because I didn't have a choice. I didn't have investments. I didn't have any other source of income. And if I quit my job and I didn't have another source of income, we wouldn't have been able to afford rent, and it was horrible. It was an absolute horrible experience. And so about 6 years ago, I made it, I quit that job, that I was in, and I moved across the country, moved down here to Austin, Texas, got a new job, changed a lot of things. My wife was, and I were just recently married. She, migrated from Germany. And so now we're here in Austin, Texas. And, I was finally making some money. She was making some money. And then I was thinking to myself, okay, well, I got all this money, what do I do with it? And, there was a lot of people that I worked with that drove really nice cars. And I thought to myself, well, what could I do with the money? I mean, I guess I could buy a Porsche. And I was literally thinking, okay, well, I guess I could buy a Porsche. That would be cool. And then I started doing the math in my head. I was like, wait, if I don't buy the Porsche and I invest the money instead, what could I do with my time? And that's where the light bulb came on for me. And I started thinking about, okay, actually, if I don't spend money spend money on some fancy car or fancy house and invest the money instead, we could actually buy our freedom. And that's where I really started learning about the FIRE movement. And that's where this whole journey started. So a lot of you, the reason why I'm sharing that story with you is when I first started learning about investing, it was very complicated. I was going on YouTube, I was going and reading different articles, trying to consume as much information as I could to solve this problem that I had around, well, how do I invest? What do I do? Why is it so complicated? And I remember just getting so frustrated from all the options. It was like I was in Baskin Robbins and there was a million, flavors of ice cream, and it was just too complicated. It was too hard for me. And so it wasn't until I started dumbing it down for myself and making it really easy and just simplifying it that I really gained confidence in what I was doing, and it really helped me sleep better at night. So the goal of this video for me is to help you learn how to simplify your investing, that more is not necessarily better when it comes to investing, and really taking a simplified approach to building a dividend growth portfolio. Before we dive into today's video, I'm excited to share that I partnered with M1. I personally used M1 for over 3.5 years and can honestly say M1 is my favorite brokerage as a dividend growth investor. I decided to transfer to M1 back in 2019 because I wanted to simplify and automate my investing. My favorite part of M1 is how simple it is to build your pies and automate everything. Even though I have everything automated, I probably open the M1 app on my phone 3 to 4 times a day. There's just something about seeing my portfolio grow each day, and I get really excited about that. My wife is not the biggest finance nerd like I am, but she regularly tells me how much she loves checking how many dividends she gets paid each month using the M1 app. In my opinion, M1 is the best brokerage for dividend growth investors. I would never recommend something that I don't personally use myself. In 2019, I transferred my brokerage from Robinhood to M1. The transfer process went very smoothly and only took a few days. If you're looking to build a dividend growth portfolio, I can highly recommend M1. Try M1 by using my link in the description below. Thank you so much, M1, for sponsoring this video, and thank you so much to all of you who have supported the channel. But yeah, when M1 reached out and they said that they'd love to sponsor one of my videos, I was like, man, that's like a perfect fit because I talk about them all the time anyways. And I was thinking to myself, like, it goes so well together, like, you know, like peanut butter and chocolate. And it probably looks a little like this.
Chocolate. Peanut butter. Hey, you got your chocolate and my peanut butter.
Peanut butter on my chocolate.
What?
Delicious.
Two great tastes that taste great together. Reese's Peanut Butter Cups. Real milk chocolate, delicious peanut butter.
Reese's Peanut Butter Cup.
Many months later.
Hi.
Oh my gosh. Oh man. Okay. All right. Really quick here. This is really important. It's important that you understand the rule of 72 because when we talk about time horizon, if you don't understand the rule of 72, this is something that you'll definitely want to research and make sure that you understand. It's how quickly an investment is going to compound and double. And so just for context, if you're investing into a bond, or maybe a slow growing company versus a growth stock, they're growing and compounding differently. And so when you're thinking about your investing time horizon, and when I recommend one ETF over another, it's based off of compound rates and it's based off of the rule of 72. So it's really important that you understand the rule of 72. In addition to the rule of 72, it's very important that you understand how the market works and that every single year, the market is going to react differently. What you're seeing on your screen here is the historical performance of the S&P 500, the largest businesses in the United States. And you'll notice that some years that the market ends in the red, and some years the market ends in the green. And it's important for you to understand that the market historically, which is never a guarantee of, of the future, the market historically has always been in the green a lot more than it has been in the red. In fact, if you go back in time, about 80%, give or take, 80% of the time the market goes up. So that means 20% the market is in the red. And depending on how long you've been investing, it's important that you understand this. If you've been investing for decades, you do understand this. If you just started investing these last couple of years, you only know the last couple of years. So it's important that you know your history when it comes to the market, and you shouldn't invest all of your portfolio based off of the historical performance of an ETF or an index for the last 2 or 3 years, but rather you should zoom out and understand and see the big picture. Okay, now that's important because I'm going to recommend some things in this video that you're probably not going to agree with. If you're new to investing, if you just look at a few charts over the last couple of years, you're gonna be like, Jake, you're an idiot. Why are you suggesting that? And you're gonna go crazy and you're gonna be fuming and you're gonna pull up the comments and you're gonna leave a nasty comment because you disagree with me. That's okay. You can do that, but understand that the stock market has been going and been working in the background, whether you've been invested or not, whether you've been alive or not. Okay, and so that's important that you understand that. And I'll reference this in a second so that you know what I'm talking about. So before we look at the individual portfolios here, it's important that you understand why I'm suggesting SEHD and DGRO and not other ETFs. So for my other video, the Simple Path to Wealth, the number one question that I got was, well, Jake, why are you suggesting SEHD and DGRO and not SEHD and VYM? Why are you suggesting these two? And so I want to address this question because I probably got asked this question probably 100 times. Like over the last couple of weeks, I've had this question asked, I think almost 100 times. So I answered it a little bit in the original video that I shared a couple of weeks ago, but I want to go into more detail about why I'm suggesting SEHD and DGRO as the simple path to wealth. Now, I'm not saying that you can't also invest in a VYM. Absolutely you can. But what I'm saying is if you want to keep it so simple and so straightforward and just have one or two, these are the two that I'm suggesting. Okay, the first thing that I want to highlight here is what I was talking about earlier with the historical performance with the S&P 500, right? Each year, the market has reacted differently. And a lot of people that go here on YouTube, generally a lot of people on YouTube are newer to investing. That's just the general demographic. Not everybody, but a lot of people. And a lot of people that are on YouTube have just recently started investing. And the people that have just recently started investing, all they're looking at is maybe looking over the last 1 or 2 or 3 years, maybe, right, since the pandemic. And a lot of people, they pull up these charts and they say, okay, well, SEHD has done the best the last 3 years. Okay, that's going to be the case going forward. Therefore, conclusion, SEHD, that's the end of it. Well, you really should zoom out. You know how we talked about earlier, right? You need to zoom out and see the big picture. And when you zoom out a little bit further, and I want to be clear, 3 to 5 years is not really zooming out, okay? But these ETFs have not been around for forever. But what I want to show here is, yes, SEHD over the last 5 years has done very well. The economic cycle, the economic conditions from 2020 to 2023 are very different than they were from 2012 to 2018. Or any other time period, okay? So it's very, very important that you don't get short-sighted when you're thinking about your future in investing. You don't want to just look and cherry pick, the different time horizon, the different charts that fit your narrative, okay? You really want to take an objective view of what you're looking at and try to make the best decision that you possibly can with the information that you have. I want to show you really quick why I like DGRO, why I like SEHD, and it's more than just the historical performance. This is only a part of it. But really quick, you can see, back before the pandemic, DGRO was the winner of the three here, right? DGRO outperformed SEHD and VYM all of these years leading up to the pandemic. It wasn't until recently that SEHD really started to shine. And a lot of people have been talking about SEHD here on YouTube, and there's like a cult following behind SEHD. And, I love SEHD. It's a great ETF, but you have to understand that the mix, the breakup of the holdings in SEHD, they're very different than a lot of other ETFs. Like SEHD and VYM, they're fundamentally different. And DGRO as well. And because there's only 100 individual holdings in SEHD, I see that as too risky. For me, that's not enough market participation. And so that's why I don't recommend just SEHD. I think, you want a little bit more exposure to the market if you're new to this and you're thinking, okay, I'm just going to only invest into SEHD and call it a day. I think that that's a mistake. It's a mistake because you're only getting exposure to a very, very, very small percentage of the market. And as we know, we can't predict the future. You don't know what areas of the market are going to do well in one decade versus another decade. You just can't predict the future, okay? And that's why it's so important. So here very quick, if you compare these, so SEHD has 104 holdings, VYM has 443, and DGRO has 452. Okay, so I'm not going to go into the individual details of these ETFs. I've shared that on my channel. You can go on my channel and watch the individual videos that I've made on these ETFs. I want you to understand why I'm talking about these two specifically. And in order to understand that, we're gonna look at a few things here very quickly, and I want you to understand and see what is the breakup or the mix of the performance based off of a few different scenarios. Let's say, for example, you had one portfolio with 50% SEHD, 50% DGRO. You had another portfolio with them split evenly between DGRO, SEHD, and VYM, and you had a third portfolio. This is really just a benchmark because I want to illustrate that what I'm suggesting is comparable to the broader market. Okay, that's really, really important because the simple path to wealth, it really has to encompass broad market diversification. Okay, and especially if we're talking about decades here, diversification is very, very important. And a lot of people on YouTube, they don't talk about that. They just look at a chart and they just look at the performance and they call it a day. I think it's so undervalued, understanding what percentage of the market you're getting exposure to with your ETFs with these investments, especially when you're focused on dividend and dividend growth ETFs. Okay, so if we look here and we look at the performance of these different portfolios, you can see here in the bottom, you can see that the portfolio with SHD and DGRO, that this portfolio has performed the highest. The second portfolio here with the 3 ETFs is performing well. It's still beating the total US stock market, but it's just slightly underperforming what I'm suggesting. Okay. Now, it doesn't mean that you can't go and invest into all 3 of them. You can if you want, but what I'm suggesting is you don't have to. You don't have to if you don't want to. And I'm going to go a little bit deeper and explain this a little bit more, but I want to illustrate and show you that what I'm suggesting, that the performance, the historical performance backs up what I'm saying and what I'm suggesting. Okay, so this is the historical performance since 2015. Now, bear in mind, this is not really representative of, a true historical performance because it's only been, less than a decade. So take this with a grain of salt. Okay, now really quick, this is probably the most important part when understanding why I'm suggesting SHD and why DGRO. Okay, so when you look at the fund overlap is if you invest into SHD and DGRO, what percentage are you getting the same thing? Right? The exact same thing. And what we want to look at is right here is the overlap by weight. Okay. And so when you compare SHD and DGRO, there is a very low overlap of only 22%. This is very low. So what that means is you could say, all right, well, there definitely is a case to hold both of them. You can hold both of them without having a lot of overlap. The other example that I wanted to share is with SHD and VYM. SHD and VYM are fairly different. They're a little bit more similar than with DGRO. It's equaling 28%. Okay, so this is important that you understand why DGRO versus VYM. Now, if you compare DGRO and VYM, you can see that there is a very high correlation. They're very similar. 68%, over two-thirds of these 2 ETFs are similar. Now, this is probably the most important part, and if you're going to pay attention to anything around why DGRO versus VYM, this is the reason why. VYM, when you compare VYM with the total US stock market, you're only getting 36% market participation. 36%. That is not a lot. When you compare that with DGRO, when you compare DGRO versus VTI, you're getting 49% market participation. This is why I am suggesting DGRO over VYM if you only want to hold 2 ETFs. If you truly want the simple path to wealth with dividend investing, it will suffice to have DGRO and SHD in a portfolio. Now, if you want to have VYM in there as well, go to town. You can do that. But if you want it to be very simple, very straightforward, you don't need it. You don't have to have it. You accomplish, in my opinion, the desired outcome of broad diversification, low fees, dividend growth with SHD and DGRO. Now that we understand how these ETFs are different, talking about SHD, DGRO, and VYM. Now I want to talk about 4 different portfolios that a new dividend investor or even a experienced dividend investor could consider. Now I want to preface that these are just mere examples. These are starting points. These are portfolios for your Roth IRA, for your taxable account. These are portfolios that you could dollar cost average into and sleep well at night. These are portfolios where you don't have to spend hours and hours and hours on research and worrying if you got the right portfolio allocation, the right mix. These are really the simple path to wealth with dividend investing based off of your time horizon. So for a 0 to 5 year time horizon, that meaning if you're planning to live off of the dividend income from your portfolio in the next 0 to 5 years, this is a portfolio that you could consider. So, for example, what I'm showing here is I have 3 ETFs in here. The first, I have SCHD and DGRO. I also have JEPI in here. Now, JEPI I've talked a lot about on my channel. The benefit of having JEPI in here is you get that extra income. If you're planning on retiring and living off of your portfolio in the next 5 years, I can definitely see a case to have JEPI here in the portfolio. If you don't want to have this ETF in your portfolio, that is completely fine. You could have more into SCHD. You could do, for example, a 60-40. You could do 60% SCHD and 40% DGRO. That would be completely fine. But in my opinion, if you want that additional income, I think JEPI could be definitely a way that you could increase your overall dividend yield without taking on a lot of risk while still keeping it very, very simple. So in my opinion, this is the simple path to wealth if you have a 0 to 5 year time horizon. And here's the cool thing. If this is too simple for you, you could add, additional ETFs or individual, dividend companies in here if you would like, but you don't have to. And that's why it's so simple. And that's why I'm such a big fan of this. The next here is the simple path to wealth over the next 5 to 10 years. Now, 5 years is pretty different than 10 years. So we're capturing we're throwing a pretty wide net when including 5 to 10 years. And so in my opinion, if you want to keep it simple, and if you believe that you have a 5 to 10 year time horizon, I firmly believe that you could invest 50% into SCHD and 50% into DGRO and call it a day. So if you have a 5 to 10 year time horizon, keeping it simple with these two ETFs, in my opinion, is the way to go. And here's the cool thing. Once you get closer to retirement, once you get closer to living off your dividend portfolio, then you could look to include or add an ETF like JEPI that has a higher dividend yield. Okay. But for now, for the next, 5 or so years, you wouldn't want to include JEPI from the beginning. You could always add it later, okay? And there's a couple of reasons why. One, because of the rule of 72. Because these covered call ETFs, they don't compound and grow as quickly as, dividend growth ETFs like SCHD or DGRO. So very, very important. So it's important that you understand that you could be flexible, that this is maybe something that you start off with, and then as you get closer, you could look to add, potentially, bonds, cash, high yield savings accounts, covered call ETF. There's so many things that you could consider. But for now, this is how I would recommend setting it up if you have a 5 to 10 year time horizon. Next one, looking at the simple path to wealth with a 10 to 20 year time horizon. Now, this is even a bigger gap of 10 years. That's a really big difference. Keeping it very simple, what I could recommend is if you want to focus on keeping it simple and you have a 10 to 20 year time horizon, I would recommend focusing on DGRO and SCHD, but increasing more to begin with DGRO and less with SCHD. And it really has to do with the current dividend yield. These two ETFs are growing and compounding at a similar rate. But the difference is over the next 10 to 20 years, you don't want to be burdened with the dividend tax. And so assuming that this is not in a Roth IRA, my recommendation would be to keep DGRO higher. And as you get closer and closer, as each year goes by, you could consider equalizing these. But to begin with, if you have a 20-year time horizon, in my opinion, it would make a lot more sense to have SCHD at a lower percentage, especially if it's in a taxable account. Now, if it's in a Roth IRA and you wanted to keep it simple and you're reinvesting the dividend, I could see a case where you could do 50-50 if this is in a Roth IRA, but it's not going to be the case for everybody. So you have to really evaluate your particular situation and understand what's the right approach for you. For the last portfolio here with a 20 plus year time horizon, I've taken a different approach simply because of the fact that 20 years plus is a very long time. No one can tell you for sure where they're going to be. So many things happen, life happens. No one knows what they're going to be doing. No one can foresee and predict the future, what their expenses are going to be. It's just purely impossible. And so what I'm suggesting here with the simple path to wealth, with dividend investing, with a 20-year time horizon, I'm suggesting something a little bit different. And what I'm suggesting is still focusing on DGRO and SCHD, which will make up 70% of this portfolio, 40% into DGRO and 30% into SCHD. The other 30% I'm suggesting to include into VTI. VTI is the total US stock market ETF, and it is market cap weighted. What that means is you don't have to pick the winners. And over time, over a 20-year time horizon, you have no idea what the market is going to look like. You have no idea what's going to happen in the future. We can try to predict the best that we can, but the reality is we don't know. And so by having VTI in here, you accomplish a couple of things. The first thing is because it's market cap weighted, you don't have to pick the winners, you get the market. And that's that. You get whatever the market does. Okay, that's the first thing. And in my opinion, that's a positive, by the way. The second thing is by having VTI in here, you spread out your risk. And it lowers the uncertainty of what could potentially happen in the future. So that's the second thing. The third thing is it gives you options. Because VTI is not really a dividend-focused ETF or investment, it's just focused on the total US market, it gives you options because then you can do more with it. Say, for example, you have a large expense, you buy a home, or you get married and you have kids and you need to, there's so many different options. What you can do is you can reposition and rebalance your portfolio. You could potentially sell out of VTI, use the money, the capital from that, and then purchase something with it. You could buy a house, for example, or you could buy more SEHD. At the end of the day, what I'm saying here is it gives you options because 20 plus years is a long time and no one can predict the future. And in my opinion, the whole purpose of the Simple Path to Wealth is to keep it simple and acknowledging the fact that you can't predict the future. And that's why I'm suggesting these 3 ETFs in the Simple Path to Wealth with a 20 plus year time horizon. Thank you so much for watching, everybody. I truly believe that keeping things simple and really understanding what you're investing in is the best path to financial independence so that you can buy your freedom. These ETFs that I talked about in today's video, I personally invest in all of these. These are market cap weighted ETFs at low fees that I believe your normal person can invest in and sleep well at night. Thank you so much for watching, and I'll catch everybody in next week's video.
Please subscribe. Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.